Welcome everyone to another episode of Macro Matters. This is our bi-weekly conversation where we cover what matters in the macro world for our members, our investors out there in the world. My name is Lotta Moberg. I'm at William Blair with the Dynamic Allocation Strategies team, and I am again joined by Tony Zhang and Rich Excell, both of the Geese College of Business. Welcome, guys.
Lotta, how are you doing today?
Hi, Lotta.
Thank you.
Hi.
And today is January 10th for context. It always takes a couple of days to get this out, so for you listening. The big topic that everybody is talking about, which we also want to cover, of course, is interest rates. So we have seen a pretty good move in interest rate, not only in the US, but in broadly in Europe as well. And it finally seems, some people will say, right, that the whole combination of growth expectations, inflation, things are coming together here, increasing rates, which one of those components actually matter and what our expectations are for this is what we want to cover today. So, Rich, why don't you give us an overview of more of what we're seeing here in this context as we're looking at the markets today?
Sure, thanks, Lotta. I think that, we want to put things into context because in the grand scheme of things, obviously rates are still near all-time historic lows, right? And so even though we've seen some very large moves in the grand scheme of things, they're still very, very low. However, as we know, when rates are low, even 10, 20 basis point moves can be large in a percentage term, and therefore can be large from an investor portfolio standpoint. If we look at what's gone on this year, so far this year, we've seen the 10-year yield breaking out above the highs of last year. And if you remember, we hit the highs of last year in the spring, in the April-ish May period, and it really kind of sold off and traded lower for most of the year until the very end of the year. And now we're starting to break out to the highs of the year. But I think the biggest move that has people kind of scratching their heads is in the 10-year TIPS yield, where we've seen a move of over 37 basis points so far this year, which, putting into context, again, in absolute terms may not sound like a lot, but that is in the 0.3% of all moves in history in the TIPS yield. And so it's a very large move on a percentage basis. And so what's kind of going into this? Last week, the Fed minutes for the December meeting came out, and most people who heard those minutes were talking about how the Fed sounds so hawkish. And we've seen that reflected into the interest rate markets. Now we have almost 4 hikes priced in through February of next year and another 3 after that. And so the market is really expecting a very aggressive Fed for the better part of the next 18 months. Now on the flip side, the terminal expected Fed funds rate is at 2.25%, which would be the lowest terminal rate of a Fed hiking cycle. So I think if we're trying to read into this a little bit, the market's kind of sensing that the Fed might feel like it's behind the curve, might want to hike aggressively to kind of pull that back, but then we'll have to stop because things might start to break. And so reading into it, that's kind of what it seems, is that the Fed being hawkish earlier than later. And as a result, we're seeing things across various asset markets, all sorts of risk markets, respond to this higher discount rate.
And you mentioned something a little bit technical there, just for clarification. When you say the terminal rate, this is basically as far as the forecasts go, or does that show that beyond a certain point, the 225 is when forecasts actually are forecasting a lower rate beyond a certain point? And is there a timing component to that?
So that would be beyond in 2024 and later. So the Eurodollars go out beyond that, but that's where the expected hikes stop. And so, of course, I think one could say that, yes, we might see more than that, but as for what's being priced in right now, no more is being priced in outside of the 7 hikes through the end of 23.
I actually echo what Rich just said. Right now, actually, market just, if we recall what we have discussed in the podcast that we have done, episodes that we did in December, is the market really just priced in maybe 3 rate hikes in year 2022. But as the minutes from the Fed central banks meetings was released last week that we actually saw that it could be interpreted the Federal Reserve might actually kick off the quantitative tapering sooner than and faster and even more aggressive that the book has actually projected. Now, as the market actually reached the full-time high at the end of the last year, as what traditional investors are very happy about the Santa rally. Now we actually kick off this year with a tough start, just mainly due to the concerns over how soon actually the central bank is going to start the tapering and how aggressive they're going to do the rate hike. We saw the pricing model that is telling us lots of assets have been inflated because of the extremely low interest rate. Even we have seen the right now the high over the past 3 years, over the 10 year, but the real interest rate is still hovering around the zero. It's a very historical low. So that actually gives some kind of nerve to the investors, like how high that the asset pricing value or the valuation can be maintained or can go higher, or if something really surprisingly negative happen over to the market, hit onto the market, can Federal Reserve has any actual tools or power to actually to control the market? I think that's also some key factors that the market actually is really concerned about.
And it's probably important to point out that when we're looking at these numbers, there are ways of breaking down, like, why are interest rates going up? Is it inflation, or is it, you're referring to real rates? So that is the nominal minus the inflation part of this. So there is, you can basically see what the market is saying in terms of the difference between an inflation adjusted bond and a nominal bond, and that is what we call the break even, right? And surprisingly, despite the CPI, which is, as we've discussed previously, and we want to discuss again, of course, and measures these like basket of what people are buying of inflation. We have the market break even will not always reflect that very well, and often does not follow those kind of numbers. And for me, it's pretty surprising how the break even has been pretty tame. Now it has come up, but that's another kind of observation. And that's why you can also say that, oh, the real rates are actually are higher here.
And on that point, Lotta, I would just say that when I was mentioning the move in the TIPS yield, that's the real yield that I'm talking about. So yeah, even though if you look at the 10-year rate that we think of, the nominal rate, which is just the combination of the real interest rate plus the inflation expectations, 10-year inflation expectations have actually come lower this year by about 12 or 13 basis points. And so you've had a move in the real yield of about, let's say, give or take 37 basis points, and a move lower in inflation expectations of about 13 basis points. And so the move higher in the 10-year nominal rate has been about 24 basis points. So it's actually more muted than the real yield. And so it's the real yields that I think most people in the investment world would suggest that that's what the central banks have been trying to keep suppressed. They've been trying to keep them deeply negative. And as the central bank, at least in this case, the Fed, is backing away perhaps, and will be tapering a little bit, maybe a little bit more aggressively, it's the real yield that should respond more than any of the other yields.
So if I look at this from a political economy perspective, and if we take this in a historical also perspective, there was a period after World War II also where real yields were negative for a quite extended period. With economists looking at this, has called this financial repression, which refers to government wanting to keep yields really low and actually negative in order to use that mechanism to pay off their debt. So you're basically inflating away the debt while, you know, not growing it. So while forcing people not to earn actually a rate that is commensurate to even to the inflation that they're seeing. And I would certainly suspect that if they're able to, and I suspect they are today, to do something similar, that's pretty much what we are witnessing. In that lens, let's see, you might not agree with me there, but let me take that one step further then, would be to say that, well, the expectation here for the Fed to increase rate reflects their willingness to increase nominal because they believe that inflation is going to be higher and they're upgrading their inflation expectations. But they're not willing in any way to give us a positive real interest rate here going forward. Discuss.
Yeah, well, I just talked about decomposing the 10-year rate in terms of real rates and inflation. Another way you can think of decomposing the 10-year rates would be expected future Fed funds rates plus some sort of term premium or premium investors should expect for holding paper that's longer term in maturity. And what we've really seen, more to your point on financial repression, is that over the better part of the last 10 years, maybe a little bit longer than 10 years, we've seen that term premium fall from almost 2% to is actually below zero at one point in 2020, in one point early last year. And so we've seen the demand from investors to want to earn more to hold longer paper coming lower. Now, is that the central bank policies? Perhaps. Others might suggest that that's because of demographics. If you look at retiring baby boomers, not just in the US, but in Europe and in China and Japan, that demand for fixed income and demand for duration, if you will, has also caused that term premium to come lower. I think if you actually look at and run a regression of the term premium versus either the central bank balance sheet or versus the amount of negative yielding debt in the world, you would find that there's a higher correlation with the amount of negative yielding debt. And to me, I think that's just indicative that there's just been this demand from investors for duration. And I think the best example of the demand for duration is the 100-year Austrian paper that came out in the year 2017. It was a 100-year bond that came out at a 2.1% yield in 2017. And by the end of 2020, the yield on that 100-year paper was 50 basis points. In fact, if you looked at the capital gains of that 100-year bond from 2017 to 2020, it had moved up more than the NASDAQ at that point. And so that was just an insatiable demand for duration as asset liability matching in portfolios was really driving this. And if you looked at the biggest holders of the Austrian 100-year paper, there were no Europeans to be involved at all. The biggest holders were, three of them were the U.S. target date funds. The funds in the U.S. that kind of try to target a certain maturity. And then the next biggest holder after that was the Japanese pension fund. And so I think that this was maybe indicative of this demographic impulse that's been driving term premium lower, which has been holding 10-year nominal rates lower as well.
I actually really like the decomposition from Rich's comments. Lotta actually brought up a very interesting point. I think we can discuss much further right over here. And Lotta basically commented that the balance sheet for the central bank or Federal Reserve here, the direction for this movement, can it be sustainable? Or can we actually see the downsizing of the central bank? Or should we actually see the balance sheet be enlarged much further? What that being said is that whether we see the real interest rate, real yield contribute from the balance sheet movement of the central bank, could we actually have a certain impact over the economy or over the asset pricing value? I think this is the modern monetary theory is something that a lot of argument right over there, right? It's just saying that should we actually see the negative interest rate, which we do, which we have seen in the policy hosted by the Japanese central bank, also embraced by European central banks as well. Similarly, argument could also come to the U.S. Can the Federal Reserve here embrace the negative yield? This is, I think, is something in debate, even though from the real yield, nominal yield minus inflation, from a mathematical point of view, that we do see still negative 0.2 to 10-year. Now here comes to the question here. I think the investors are really have concern is whether the QT might become a starting point for the central bank here to downsize their balance sheet much aggressive than anticipated by the market. So this is something I think what market investors need to be concerned about or need to be cautious about.
One thing I would add on to what Tony's talking about there, and it's something that he turned me on to in one of the podcasts I did with Tony, is the Wuxia shadow Fed funds rate, which actually takes into account for the US, not just the Fed funds rate, but the impact of quantitative easing on the rate. Even going back to Ben Bernanke post the financial crisis, he talked about how many trillions of dollars of QE equals how many basis points. And I'll leave that up to the researchers to study, but the Wuxia rate measures and assumes some amount of QE, actually takes the US rates into a negative territory, much like in Europe and Japan. And so along those lines, kind of what Tony's talking about is this tapering that we're seeing, this reduction in purchases or the reduction of QE. The opposite of QE has to be QT, right? The opposite of easing has to be tightening. Now, admittedly, the Fed's balance sheet hasn't shrunk because they're still reinvesting. And so it's very, very modest at this point. But if we really think that and hold the Fed to what they say, we should see some QT, some quantitative tightening, which is implicitly raising interest rates already before we even get to the hiking cycle.
And you have to make some assumptions, right, about what is the economic contribution that you're looking at when you're comparing like an interest rate and the bond purchase here. But that's interesting. Well,
the interesting thing to me is I totally agree with you. There's a lot of assumptions that are being made on that, but this is it's being done by the Atlanta Fed. It's not being done by people in the market.
It must be right.
It's at least what the Fed's looking at. That's what we know. And part of our job is to try to anticipate what the Fed's going to say and do.
Yeah, exactly. I think one perspective to look into this are the dual mandates adopted by the Federal Reserve. One is unemployment rate. The other is inflation. Based on the December's number, we have seen the unemployment rate in December reach almost historical low, 3.9%. Right? We only saw a number like lower than this was the I think it's in the April or March before we actually locked down the whole economy. That's reached to 3.5%. And in other period, over the past 10 years, we have seldom seen any unemployment rate as low as what we have seen in December. So that is telling the market the unemployment has reached historical low, which actually fulfill one mandate adopted by French central bank. The other mandate will be purely just inflation. Inflation, as we discussed in last year's episode, was mainly driven by two factors here. People really I focus. One is the supply chain issue. Can the supply chain issue be improved? Right? This is something that we need to keep an eye on. So far, we haven't seen any improvement over the supply chain issue. The other is we are looking at is actually, do we see some shortage in labor supply? Something that we have to consider, right? If we look at the labor participation rate as released in December as well, which has reached to 81%. Very high number. It's absolutely very high number. It means like 81% of qualified labor has actually came into the labor market, 81%. The other thing that's actually corroborated with the high participation rate is the wage increase. If we see the wage increase faster than the average, typically historically, that we might have a concern. The Federal Reserve might eye on those data. They call themselves, they are data dependent, which we hope so. They are accountable, right? If they are really data dependent, this is the wage increase in December release is also 4.1%, if I remember correctly, much larger than the average. So both data release just a few last week, I think, was telling us that Federal Reserve might need to take some really tough decision right here. Should they become more hawkish? If they really become more aggressive or hawkish, one thing that we're going to see is that if they don't take it cautiously, the market reaction in year 2018 might come back. So this is something we see a sell-off at the beginning of year 2018 as what we might have seen right now. So we don't know. We just passed 1 week, and this is just the first day of the second week of year 2022. This is a lot of issues behind that. But if Federal Reserves are really data dependent to fulfill their dual mandates, they are something that we should be careful as well.
And that really touches on an important question of, is there economic space to increase rates, and can the economy bear it? So the numbers that you're putting out there makes it sound like this is definitely an environment where the Fed should and is able to increase rate. We have the inflation part, we have the labor. On the labor side, we know that wages are coming up and catching up with inflation. The labor force participation rate, it has recovered, but it's way below where it was before the first COVID drop. It looks like a permanent decrease to me. So it becomes a question about, one, what metrics do you want to look at? So Fed has said, we're going to look at employment rate. I would say, okay, you go for it, but it's like steering blind because you're not looking at a number that actually means anything. It doesn't tell you about the strength of the economy because it's a ratio between two things that both vary. And it matters what the numerator and the denominator is doing. So in this case, the denominator really has dipped a lot. We do have a labor participation rate that is very low. So you have that. It looks like it's great. You don't have many employed persons, but you also have a lot of people who have pulled out. So that kind of is worrying to me. So the point that we could talk about here in closing, I would like to talk about in closing, is this issue of, there is this expectation now that from here, it seems to me that the expectation is, one, Omicron and all the virus stuff, we don't have to worry about that. That's kind of going to be over with. Spring always brings kind of optimism. And we can go out and everything's going to be good on that front. We're going to have employment situation is good, inflation's higher, and all of that. And of course, they should be increasing rates. And I just always get a sense that when everybody's saying it can only go one way, it does surprise people at the opposite direction. I would certainly suspect that you're not going to have the increase in rates, or that you might get a reversal quite a lot sooner than people believe, because the next step is always increased rate. Markets are weaker. You're saying data driven, data dependent Fed. Yes, one of the data points we know is the S&P. If the market drops, suddenly you're just not going to see the increases anymore. I don't think that the expectations are going to be there anymore. So I would certainly suspect from here that the surprise is going to be on the downside. It would be great to get both of your perspective on that.
Well, I would agree with you a lot in the sense that if we think back just to the end of August, early September, right after the Jackson Hole meeting that the Fed had, the Fed was still telling you that they weren't going to hike next year. And so if you looked at the dot plots, and so the markets has been more hawkish than the Fed itself. And in some ways, I think the market is responding to the fact that the Fed seems to be moving in the direction of what the market is saying. However, I think the other thing you point to is Tony mentioned the supply chain difficulties. Well, those will slowly get worked through, of course. And of course, we're going into a seasonal slowdown here as we kind of get in the end of Q1 and beginning of Q2, where we're in the post holiday season here in the US. Will be post Lunar New Year in Asia. And so we're going to see that seasonal slowdown. And we have already started to see the ISM or PMI growth numbers around the world peaking and moving lower, still quite strong in absolute terms, but lower than the highs. And so you will start to see growth moderating, and the market start to say, hey, growth is going to slow more than we expected. And then on the inflation front, as this supply chain gets fixed, the goods inflation should come lower. The question is, you both brought up with wages, is will we see higher services inflation that offsets that and keeps it much higher? And that's where the data has to kind of come into mind. I mean, I'm old enough to kind of go back and remember in the 70s when we had what they call the misery index, which is the CPI plus the unemployment rate, which is both of the Fed's mandates, right? It's price stability and full employment. Now, if you look at CPI plus unemployment, it's at elevated levels, but it's not very high in terms of where we are in regards to history. So it kind of going more to your point that the Fed probably feels like it still has some room to be patient and to not overreact here and see what the data says.
Yeah, I agree with what Rich is saying, that we might actually need to take a wait and see stand to see where the central bank might go for the next step. There might still be some times over that, but sometimes that's what really worry about the investor or market participants is that can we actually hold the Federal Reserve accountable? As what Rich just saying that last year, maybe in October, they would just say they probably would never hike any interest rate in year 2022. And once we moved toward the end of the year, last year, then they started to talk about, oh, we might have just one hike. And since moved so fast, now here we talk about, oh, there might be some possibility that central bank could hike the interest rates 4 times in year 2022, right? I think that's really surprisingly negative. I agree with Lotta that the central bank, if they do take this kind of very hawkish stance, this might actually cause a huge, what we call the financial distress. The financial distress is highly correlated with their policy decision-making procedure. If before 2008, that we seldom see that they consider about the financial distress, but since the year the financial crisis what we experienced last time, now they actually do look into the financial distress. If we see much higher market volatility, I think this would make central bank take a pause to think about that. They might also trying to take this kind of slowing down process. However, you know, this year is a very special year. We have midterm election, so there could be a lot of factors or issue might not be related to financial or fiscal policy can be involved or counted, right? So this is something that I'm not completely uncertain right over there.
Yeah, I mean, the big question is like, are they going to be able to increase rates a lot in a year where you have all these factors going on? We still have the supply issue going on, and we're seeing a slowdown, as Rich pointed out. We've had pretty good periods in the past where we've had a recovery, we've had positive growth, we haven't had these clouds everywhere, and they still haven't increased rates. Economists sometimes say that we want to increase rates so that we can cut them, right? And now I might be biased sitting here in the sense I did attend the American Economic Association conference that was again virtual this year, and I got a sense that there were quite a lot of negativity there. Of course, you know, if you have a person like Summers in the room who has been Larry Summers, who has been pointing out the dangers of overheating, he will always have the big cloud of the room where the economists who are trying to stick to the kind of politically acceptable script will be sitting there cringing while he's talking. But there were several people, not only him, you know, that I felt were quite negative about the outlook, and so that was interesting to hear. Of course, from the monetary policy side, there was a lot of discussion about central bank digital currencies, which might be a topic for another discussion between us. And that seems to be more than what we're going to do interest rates, almost like that's what they're worrying about more, about how we're going to deal with these digital currencies. With that, I'll see if there are any final points that you would want to make, guys.
Well, I would just say to me, one of the biggest things to watch out for is any sort of continued fiscal policy that we see. Here we are early in January, and the Build Back Better reconciliation bill looks like it might be struggling. But as you both have pointed out, it's an election year, and we haven't had a major piece of legislation come through from the Biden administration. So we've always seen that from the president in their first 2 years in office. And so I think you should still have a working assumption that we'll see something. The question is, what will that be? And could that something be enough to keep growth and inflation higher than we've seen? I think most people are looking at the monetary policy and the lagged effects and expecting some sort of normalization or moderation. And it's that sort of catalyst that could kind of keep things higher for longer. And we'll see what happens. And that we should probably know that, I would think, in the next month or so.
When you say something, you mean another fiscal package?
Correct.
Spending package.
Yep.
Yeah, I would also like to maybe point out that one thing that really concerns me might not be how many times that the central bank might hike interest rate, but how soon they will start the QT, the quantitative tapering, or tightening in another way. So this is something that I would actually recommend the audience might also keep an eye on. I think that how soon and how aggressive they would sometimes would have a huge impact over the asset pricing or the valuation of the market or a lot of asset classes as well.
I think going back to the start of the conversation, we have to remember that we're still at or near all-time lows in terms of interest rates. So we should be rooting for rates to go a little bit higher. If the rates are moving higher, that would mean that the economy is growing and the economy looks kind of sustainable and strong. If we're still at all-time low interest rates at the end of 2022, something bad's probably happened.
Yeah. So everybody look out for these indications, right? The rate being so abnormally, weirdly low, it is weird. And the question is, how long are we going to live in weird land? And we might forget, us who are a little bit older, that there are a lot of people who are in the market, who are investors now, who have only seen basically negative real rates in the US. And there is another world out there, and it's the question of when is it going to come? So hopefully we gave you a little bit of signposts, things to look out for, things to think about for the next year, as well as for the future in general, for the rate environment. And with that, thank you so much, Tony and Rich, for joining me today.